All right, today we're digging into a really fascinating financial report. It's trying to make sense of the absolutely wild signals the market sent us back on February 12th, 2026. I mean, it was a day of total contradictions, and this analysis, well, it tries to get to the bottom of what's really going on.
So let's just jump right in. Picture this. On one side of the globe, you've got South Korea's KOSPI index just exploding, hitting a record high. We're talking pure AI euphoria, right? All this excitement about Samsung's new memory chips. But then you look at the US, and the NASDAQ, it's a completely different story, dropping over 2%. And the crazy part, the reason for the drop is the exact same thing that caused the rally, AI. But here, it's fueling these massive fears about white-collar job losses and a looming recession.
So, that's the billion-dollar question, isn't it? Which one is it? Are we in the middle of this amazing tech boom, or are we staring down the barrel of a full-blown panic? This report, it doesn't just guess. It pulls out some pretty powerful economic ideas to try and see through all the noise.
Okay, so to really get to the heart of what's going on with the market, the report acts kind of like a doctor. It uses a few different diagnostic tools to look past all the day-to-day headlines. And where it starts is, well, it's pretty deep. It starts with our relationship with time itself.
And that brings us to this big idea in economics called time preference. It's actually super simple. It's the classic one cookie now or two cookies tomorrow test, you know? In a healthy, optimistic economy, most people would wait for the two cookies. That's called low time preference, and it's what drives saving and long-term investment. But the big argument in this report is that we've lost our patience. Our whole sense of time is kind of broken.
I mean, just look at Google's recent 100-year bond. 100 years. In the tech world, that's like 1,000 years. So you have to ask, is that really a vote of confidence in the future? The report says, no way. It argues this is actually a sign of pure fear. It's not faith in the long term. It's a desperate scramble to get out of a currency system that people think is failing. It's a panicked move, not a rational one.
All right, next up, the report uses this really cool idea called the wild duck theory to explain the paradox we're seeing right now. The basic gist is that any healthy system, whether it's an ecosystem or an economy, needs its wild ducks. You know, the innovators, the creative types, the ones who think differently. They're what keeps the system flexible and alive. But what's happening now? This obsession with hyper-efficiency, it's basically making these wild ducks an endangered species.
And this is where it all comes together in what the report calls the efficiency trap. Think about it. Companies are bringing in AI to replace their professional white-collar staff. Looks great on a spreadsheet, right? Costs go down, efficiency goes up. But who did you just get rid of? You just got rid of your customer base. You're destroying the very people who have the money to buy your stuff. It's like a snake eating its own tail.
And if this whole thing sounds familiar, it should. The report points out that this is basically a rerun of the 19th century railroad boom. You had stock prices for railroads going absolutely ballistic based on hype, just like AI stocks now. But at the exact same time, the bond market, the smart money, was sounding the alarm, warning that these companies were drowning in debt. We're seeing that exact same split today. Stock market euphoria and bond market terror.
And this isn't just about history or cool theories. The report has the math to back it up. Their own quantitative models are flashing bright red. This metric here, volatility persistence, it sounds complicated, but all it really means is that shocks to the market are sticking around. That crazy up and down we're seeing, the data says it's not a one-off. It's baked into the system now, and we should expect this instability to stick around or even get worse for at least the next 3 to 6 months.
So that's the diagnosis. Now for the forecast. The report lays out a very specific timeline for the rest of the year, and it calls this period AI's reality check.
It basically breaks the rest of 2026 down into a 3-act drama. First, from now until April, we get the final rally. This is where FOMO, fear of missing out, drives one last crazy surge in AI stocks. Then, from May to August, the curtain rises on Act 2, the white-collar recession. All those layoff announcements, this is when they actually start to hurt people's wallets and consumer spending takes a nosedive. And that all leads to the grand finale from September to December, the debt crisis. This is when all those AI companies that borrowed tons of money to build infrastructure suddenly can't pay it back. And, well, you can guess what happens next.
So this isn't just a story about the AI sector. The report is very clear that this reality check is going to go global. We're talking about massive ripple effects that are going to hit just about every major market on the planet.
Let's start with the US.
The prediction here is a brutal 25% haircut for the NASDAQ 100 as that AI bubble finally pops. And to make matters worse, inflation is expected to stay stubbornly high, which means bonds won't be a safe place to run to. Basically, there's nowhere to hide in the US market.
And what about Korea? You know, the market that was just popping champagne bottles? The report sees a complete 180, a 30% drop for the KSP. That HBM chip momentum that everyone was so excited about, it's expected to just fizzle out. And there's a double whammy. New rules are coming in to clean out these so-called zombie firms, which is going to put even more pressure on their tech market.
Now let's talk currencies. The report is flagging two big moves. First, the Japanese yen is expected to get stronger because the Bank of Japan will likely start hiking rates. But for the Korean won, it's the opposite story. It's predicted to get weaker as all that foreign money that rushed in starts rushing right back out.
And they're not just guessing, they're putting a number on it. The forecast is for the Korean won to hit at least 1450 against the dollar by year-end. That is a huge move, and it's all driven by that fear of foreign capital fleeing the scene.
And the hits just keep on coming. The report points to a whole bunch of other global problems. Europe and the UK, stuck in a low-growth rut. China, being squeezed by US tech restrictions. Even oil is projected to take a tumble because there's just too much of it. In this whole messy picture, there's really only one major bright spot: gold. It's expected to soar as everyone runs for safety.
So, when you take all of this, the weird psychology, the historical echoes, the hard data, the forecasts, what do you get? Well, the report ties it all together with one big, powerful concept. It calls it the Great Reversion. And this right here is the key takeaway. The whole argument is that the party's over. The era of just throwing money at AI hype is ending. The Great Reversion is basically a return to reality. It's a world where things like, actual profits and how much debt a company has suddenly matter again. A world where real-world economics wins out over futuristic promises. And so the report leaves us with this one last thing to chew on. In the world that's coming, who's going to win? Is it the person with the best spreadsheet? The one who relies on pure cold calculation? Or is it the wild duck, the one with the gut instinct to see what the numbers can't? That's the real question, isn't it?